the presentation I got this morning is something so much of what probably should have been at the start of the day, but some guy called John McAfee wanted to show up and do himself at 9 a.m. in the morning. Obviously, he took precedence over myself, and that's cool, because obviously people like a bit of controversy, and there he was. So that was great. Now, if you are new to this space, this is very much tailored to you. It is a very quick rundown, because a lot of people confuse themselves with Bitcoin, blockchain. Is it interchangeable? Is it the same thing? Are they two different things? And it's just trying to go back down to the very base layer of where it all came from. And then some of the other things that have come about since then, such as smart contracts, ICOs, and it is very lightly touching on it. It's not in depth by any means, but it's to give those of you out there who might be newer to this space, this is very much tailored towards yourselves. I know there's a lot of people from, obviously, projects, from industry. It probably doesn't suit you. So you are welcome, obviously, to mosey on about. Quick little disclaimer here. I do work for the federal government. This is not financial advice or legal advice. It has nothing to do with the federal government. So if you add me on LinkedIn or otherwise, please keep it separated. Now, this is an image which holds very true. A lot of people that come to these kind of conferences are looking for what is very much on the left. They're looking for to find out how to make money. And that's what initially drives people to jump into this space, unless, of course, you're technologically savvy. So what I'm trying to get at is the fact that if you understand the right-hand side of what is the underlying technology, you actually probably have a better chance in trading, in understanding the market sentiment and what's going on. Because if the technology is failing in some way, shape, or form, or there's something going on in that realm, it's going to be affecting the when to buy and the when to sell. So it's not just about trading those markets. Because it is so nascent technology, it's highly volatile. It's obviously a risky business. You put some money in, 1 week you'll be up, the next second you're down, and obviously it's a bit of a roller coaster ride. So that's where we're going to go from. Now, the genesis of the blockchain. If we go back to 2008, one hell of a thing happened. I'm not sure if you've heard of it. It was called the global financial crisis. And it was one of those things that was such a pivotal moment in time that what it changed for everybody was the fact that we really started to consider what we thought we had in trusted third parties, in that of banking, in that of, any business really, what we have with Facebook now and how much data that they actually collect, on behalf of us so kindly. And with that, it was only at the latter part of that year, the absolute polar opposite came to fruition in that of the pseudonymous identity of Satoshi Nakamoto, who created this concept that we now know as Bitcoin, put a white paper out, Bitcoin, an electronic peer-to-peer cash system. And that essentially removed, obviously, this conversation around intermediaries. And it was a perfect time to bring it out, considering the issues that were going on within, obviously, the banking sector and that global financial crisis. So I'm going to try and make this as simple as possible in terms of understanding what a distributed ledger is and how blockchains fit into that puzzle. Now, if you're offended by how simple this is, once again, please, you can go somewhere else, it's fine. I'm not going to be offended if you get up and walk away. So we're going to start with this concept of Alice and Bob sitting on a park bench. And Alice and Bob are going to be transacting an apple. So Alice has the apple initially, and Bob wants that apple from Alice. Now, in that physical transaction, if Alice was to hand that apple to Bob, Bob knows in his whole heart that he owns that apple. And the reason for that is because he has it in his hand. He knows it's an apple. He knows it's maybe the favorite royal gala that he likes. And he knows that Alice now, which once had an apple, no longer has that exact apple. Da-da. That's all right. With this physical transaction, we don't actually need to bring in an intermediary. I don't need to bring in my, favorite lawyer mate to look over that transaction and tell me that that is a good transaction, that, you have transacted an apple and Bob is the rightful owner of that, because we all do this on a daily basis. But what about if I was to say to you I wanted to trade digital apples? And if you think about that for a moment, it's actually very complex, because how do I know that Alice hasn't given her apple to Karen or to anyone else in the front row before trading it with me? And I don't initially. And how do I know that she hasn't uploaded onto a website and it's been downloaded 1 million times, and that apple obviously is now owned by everybody else? And what we're talking about here is known as a double spend problem. And this is something that, with banking or with your ATM machine, if you walk up and you've got $50 in your account and you've got you and a mate and you've both got an FPOS card for the same account and you plug them in, you can't pull $100 out. It stops you at that point because they're that central authority that says, wait a minute, no, yep, okay, there's only one transaction here. And they timestamp that and go, in that moment in time, you only had $50. You can't take more than that. So what about if we were to introduce a ledger, an accounting ledger, just like you do for any business? So when Alice transacts to Bob and transfers that one apple, we write it down. Nice and simple. Then when I transact to Martin, to Michael, to anyone else in the room, we write those transactions down, and that ledger keeps filling up as we go along. Now, what about, in this circumstance, if we wanted to give a copy of that ledger to everybody around the world, so they had the exact same thing at exactly the same point in time, timestamps in a chronological ordering of events? What that would mean is that even if Karen, for example, who owned the ledger singly before we distributed it to everyone else, and she said, hey, Alice actually has 5 apples after this transaction took place. Now, let me be clear, I'm just using Karen because she's there. This is not what she would do. But if Karen knew that there was 5 apples in Alice's account, after that transaction took place, she could, change the numbers. Instead of 1 being transacted to Bob, she might have changed it to be 5 transacted to Bob. And obviously, we don't want that to occur. So this is why we distribute it out to the network and we say, hey, everybody out there, there's thousands of you. If you all have a same copy of the events, all those transactions at any one time, we've reduced the risk that we have by having that central identity, that trusted third party, as a person to obviously say that these are the true logical transacting of events. So there we go, we push the apples out to the market and everyone gets a copy of what's going on. And if the one down the bottom then, tried to obviously change the fact that I only transacted 1 apple but knew that I had 5, unless majority of the consensus in that network, unless more than 51% of that network agrees to the fact that I actually transacted 5, my mistake, sorry guys, that will not happen. And that's known as the Byzantine general's problem. I'm not going to go into that, but I'll let you investigate that one on your own. So let's give it a definition. So a blockchain, from what we've talked about here, is a cryptographically secure distributed database. So that distributed ledger we just talked about is essentially a database. It stores data in a particular way, in a way that is distributed across the nodes, but they have the same copy of everything at any one time. And it maintains, obviously, this growing list of records. These records can only be appended to by the majority of consensus, which we've just talked about there in terms of the apples, is that unless the network agrees by the rules of that network, which are codified in software, it simply will not be added. That transaction will be pushed to the side. And when we talk about transactions, it can be apples, it can be housing, it can be dollar value. In the digital world, anything is possible because you can tokenize that particular asset and say that for this asset, this is what we mean, this particular token. The blockchain consists of those transactions in that ledger. And obviously, once that ledger gets full, that's what becomes that block. And that block has to be mined by the network. Now, there's a multitude of ways to obviously go about this mining process. Once again, I'm not going to get into that with you. But it's essentially just understanding what makes up this blockchain that we talk about, or this distributed ledger. And a block represents those transactions that have occurred and have been verified by the network to be true. And then it breaks off at the bottom there, and it just says that blocks are then cryptographically linked to each other. So in the original white paper, there was actually no talk of a blockchain. It was talk of a chain of blocks, because there was a hard limit that was actually set in code to say only this amount of transactions or this amount of data can be stored in one block at any one point in time. Now that can be changed. You can have more in a block at any one point in time, which I'm sure you'll hear about from the guys from Bitcoin Cash, because they love to say that they've got the biggest blocks. But that means something to the network. It might not mean anything to you, but essentially what it means is that you could do more transactions at any one time per second. But there's things about that which are obviously either detrimental to one portion of the puzzle. So it could be detrimental to the decentralization of the network. It could be detrimental to then the security of the network. And with those linking of blocks, it's as simple as this. So when a block is formed, it's like a stamp on a postcard. You kind of putting that wax stamp on the back to say, it's now sealed. We've verified everything in this block to be true. And we give it, a specific, what is known as a cryptographic hash. Now, a cryptographic hash has certain properties. One of those being it's deterministic. So what that means is essentially the same amount of data that's input will always render the same output. So if I was then to go and try and change any transaction that's actually in the block, I'm going to get a different cryptographic output, which means the next block that actually has the hash of the previous block embedded in it, which is where you get your chain of events or your linkage of the blocks, means that the whole chain from there onwards knows that something's gone wrong back here because the rest of the hashes no longer line up. So to bring that back, and we'll just quickly look how simple blockchains are. You have a transaction, you put it out to the network. So I say, I'm going to transact Alice to Bob. We go, everybody, we're going to transact now. I want you all to have a copy of this. It then gets validated by those miners in that software to go, yes, this is true. Ben, at the time, did have enough apples to transact. He hasn't double spent them previously. It then gets added to that block. That block gets sealed with that cryptographic hash. It creates this chain, and we are complete. So what are the key components we're talking about here? Why is it adding value to business processes as we see it now, but also interactions between you and I? Well, it's distributed. We've just talked about that. And it's immutable. It's immutable in the fact that there's always a chain of events. So if somebody did try and fudge, morning Hayden, how are you? Good. If you did try and change the chain of events, you may fudge the numbers, but there'll always be a transaction linking back to that to let everyone know that somebody has gone and done that. Obviously, it's secured through cryptography, which is obviously a wonderful mathematic proposition that I am nowhere, shape or form qualified to talk about. It's a peer-to-peer network, so just like Napster back when we started sharing music, we're able to interact with each other. So for business, it's a massive win because you're cutting out intermediaries that we might be able to do in a much more efficient manner. Obviously, we have a lot of ICOs out there now, so you have a lot of digital assets that are being created, and this ideal around crypto economics, building a project which is built up on a range of elements. So with that crypto economic side of things, Bitcoin is the first killer app of blockchain. Bitcoin is built up, it's a meta technology, it's built up of a range of things. Bitcoin uses a blockchain for its data storage, but it also uses game theory to incentivize and disincentivize people to do the right thing on the network. So that's when you mine a block, you get paid. Or if you don't do certain things, you could be, in a proof of stake network, you could lose all your funds that you've staked. And of course, what we're now calling smart contracts. So what are the value drivers that we're seeing for businesses, for individuals, for the community as a whole? Well, operational efficiency, like we just talked about, removing those intermediaries. There's a risk reduction because it's immutable, it's transparent. Now, transparent in a public network, it is important to understand that as much as Bitcoin and Ethereum are great, there are also other solutions for an enterprise grade that might be privatized, whereby they can use the blockchain to build trust within their network, but it doesn't have to expose any of that information to the outside world. For example, government agencies in Queensland, in Australia, they might be able to use this database. One use case that is a possibility is that the department I work for, which is the Department of Human Services, we are an intermediary in that of child support. So when child support payments go out, mum or dad, not going to get into it, might have to pay, what used to be the ex-spouse. And because of that, we literally just take the money and then forward it on based on what is, the agreement between the two. It's a possibility that a blockchain solution could be used there. Transactional efficiencies. So you're seeing, obviously, you can transact a lot cheaper, especially for merchants. Merchants get slogged for me to buy my coffee every day. They shouldn't have to pay that cost. And it's also one of those things that with PayPal, with Visa, they can reverse those transactions many months later. Whereas on the Bitcoin blockchain, it's said that after 6 confirmations, which is around about an hour, that there, in time, set in stone, will never have it's theoretically impossible, it's probable, like to the smallest umpteenth degree, that it will ever be turned back over. It's transparent. There's new revenue and capital efficiencies that we're finding here in terms of, crowdfunding exercises, getting mum and dad to do and start a business. A project that I work with is ETHLEND. It's a decentralized peer-to-peer lending platform based out of Switzerland. And essentially it's looking at the unbanked, the de-risked, but also you and I. It allows people in sub-Saharan Africa that might, not have any ID, they might not have any land rights or anything going on there, but they definitely have a mobile phone. And they use services like that over there, and they can definitely use these platforms to go and start their own business and lend against something that they might already have. So where have we gone to from there? So with that distributed ledger, obviously we've seen Bitcoin initially. We've now moved into the whole ICO, cryptographic assets, and they're building on that with smart contracts to automate particular processes. And smart contracts are simply, if I do this, you're going to do that. Now, they can be a lot more complex than that, but that is the general gist of what we're looking at here. So smart contracts actually were first coined by Nick Szabo back in 1994 in a research paper. And Nick Szabo was one of the original kind of cypherpunks that started this whole movement. And with what he talked about back then, there was no real technological means to this smart contract. And what he wrote in this research paper was to say, let's make something in code, programmatically, so hard to break in terms of, a contract between one another that they won't want to do it. Now, under Australian law, that's illegal. I think it was the CBA, but I'll be quiet. It was a case between Pacquiao and someone in a high court. And essentially, one of the big 4 banks in Australia put some terms and conditions around the way that they were offering services to Pacquiao that were, it put him in a particular sense of business where he didn't want to break that contract even though it was actually better for him or there was other ways to go about it. And then we came to Ethereum. So Ethereum came out in 2015, and it really gave that concept of smart contracts the lifeblood that it needed to come to life. And with that, it built on what Bitcoin had and added this concept of a world computer. So if we had something that we could think of in our minds, we could programmatically do that. And that's what they call in terms of Turing complete, which is named after Alan Turing, who's a computer scientist. But this is the funny part for me, and it's something that I've picked up from a gentleman in the Brisbane scene called Dr. Adrian McCullough, who works for in the legal space, but also all over Harvard with ICOs. And it's actually a misnomer in terms of the name smart contract. It's what lawyers would consider a Humpty Dumpty-ism, in the fact that it's not actually smart or contractual, specifically in Australia. And what I mean by not smart is the fact that it only knows what it knows in its state at that point in time. So I've said, if this, do that, it stays in that particular state unless it has some form of consciousness state like we do. So sometimes when we set contracts, we go, we'll think about all the conditions, but if something pops up, we know as human beings that we can have some form of intermediary, we can go and change the terms of that contract. In code, that's not what happens. What is coded will particularly happen, and that is it. This is where this concept of oracles come in. And oracles allow these smart contracts to essentially reach out of the blockchain world into the real world and get real data from it to make a more informed decision. And an example of that is if I had an insurance policy with my Amy or otherwise, 2 minutes, let's jump through. Essentially, smart contracts aren't legal in Australia because you have to have offer and acceptance and that capacity to make that legal relationship. Unfortunately, software and also robots aren't considered legal entities under Australian law. In terms of initial coin offerings, these have obviously gone crazy in recent times, and I'm going to speed through this, but I won't watch this video, but essentially what comes out of this video, if it goes through, is that this year huge amounts of money has been raised with ICO. So the top one on the right-hand side, EOS, 4.1 billion. Now that was done majority with private sale VC funds, but obviously there's a large amount of money coming into the space. So if you look up on the top left-hand side, 2018, the average ICO across the world is earning 25.5 million per ICO. It's a lot of money to take off peer-to-peer networks when you don't have a product. And that's what the reality of a lot of these products are. They don't have an MVP, a minimum viable product, to go with. And what Andreas Antonopoulos once said is that if you go to Silicon Valley, you go to your hotel room, you turn off the lights and you look in the mirror and you say, blockchain, blockchain, blockchain. VC firms will jump out of the closet and just hand you cash. And unfortunately, that's not what's happening. Well, it is what's happening in the world right now. And that's what we just need to be aware of is, do they really need all that money up front? And maybe the IPO model of having some money now, some money later is actually a better model. Because this is what we're ending up with. They promise what's on the left, you get what's on the right, and it might not even work even though it looks like a great drawing from a child. I won't go through that. Essentially, it comes down to, do I need a blockchain? So we started off at the start, blockchain is Bitcoin. No, Bitcoin utilizes a blockchain. Blockchain is not crypto. Crypto is blockchain. You're getting closer. Then we get the third, and it's like blockchain can be used for everything. Very smart minds have been in this space for over 10 years, and let me tell you, there is limited use cases for that, and you need to find the right one for your market to ensure your consumers will have value in the product that you're driving home. And then finally, at the end, you get, I probably don't need a blockchain. It's cheaper to use a normal database. And there's common use cases. I'm not going to go through them because I'm already over time. But, supply chains, file storage, IDs, programmable currencies, we know all of this stuff. And this is kind of where we're at now. So Bitcoin at the start was, the big boss of the world. And now we're moving on, like the rat from the Ninja Turtles. And these other platforms are coming along and building on that premise of what is to offer.